Hello, good afternoon. This is your realtor, Ogadema Ichoku. I want to welcome you to my YouTube channel. This is going to be first of many videos. In this platform or on this YouTube channel, I plan on closing the information gap between a lot of immigrants or first-time home buyers and the people whose parents have owned homes in this country for generations. You will find that people that have lived here or that have lived in homes owned by their parents do not understand or take for granted the things that they've learned over the years. They might have heard their parents talk about property taxes, PMI, they've heard about HOA, they complained about taxes going up, school district and stuff. But you, a first generation American, the first person in your entire lineage or generation buying a house in this country, you're going to hear a lot of things that sound like Greek to you, and it's not your fault. I mean, I want to say congratulations first. Congratulations is in order because here you are in a whole different country, first person buying a house. And chances are you're not going to be the last. So I want to congratulate you for this very serious accomplishment, for realizing or coming close to realizing your American dream. So today I want to talk to you about mortgage. That's the first thing. What I've seen is that a lot of people walk into trying to buy a house and they don't know much about mortgages, and that's serious because as it is said, you don't make money when you sell a house in real estate. You make money when you buy a house. Let me repeat that. You don't make money when you sell real estate. You make money when you buy it. And this places so much emphasis, or this tries to state that it is absolutely important that you, from the get-go, when you're trying to buy a house, that everything is set up so properly to ensure that when you sell it, you're not going to be selling at a loss and you're going to make money. So I want to help today to teach you how to understand your mortgage. So let's get into it. As many of you have heard, a mortgage comprises of four things. That's what you hear on most channels: principal, interest, taxes, and insurance. But that's not the case. There's a lot more. There's PMI. A PMI, or mortgage insurance premium, MIP, in FHA. This is something that you pay as along with your mortgage when you don't put 20% down. There is also HOA. HOA fee is also can be substantial. In townhomes, HOA fees can be as much as $300 or more. In condos, they're a lot more. In residential houses, they're a little cheaper. We're gonna get into that. We're gonna explain why it is cheaper and if it's really really cheaper. And then the next thing is there's PID, Property Improvement District. This might be the first time that you've heard it. A lot of people that own homes went through the whole process of buying a house and they do not know that their property is in a pit or is in the mud or has a pit or mud. So we're going to discuss that. So let's think about it. Most people think it's principal, interest, tax, and insurance. That's four. But think about it. There could be HOA. That's number five. There's PMI. That's number six. And there is PID. Okay. So we're going to go into details in discussing these things. Okay. So okay, I am also going to mention escrow. This is a good point to mention escrow. You may have heard this and you're like, what is escrow? What is escrow? I don't know what it is. An escrow account or impound account is an account that is set up by your lender to collect some fees for you. There are fees in real estate that I've listed. There are parts of this payments that are not due until the end of the year. For example, your property taxes is not really due until January 31st the next year. But the banks do not want you to not pay it to them. They don't want to leave it to you to pay it because um, it could be as much as $20,000 if you have a house that is 1 million and the tax rate is 2% and you don't have homestead exemption. The tax is 20,000. If the bank does not collect it, some people might get to January and realize they don't have 20,000 to pay for their property taxes, and they don't pay it, and the house gets foreclosed upon, and the bank loses money. So, in an attempt to protect their interest, the bank forces you or mandates that every month that 20,000 is divided into 12, and they collect that every single month. They put it in an account, an impound account or an escrow account, and hold it for you there. and at the end of the year, they pay it for you. So what is really, really due every month is just the principal and the interest. The HOA you can pay once a you can pay one they pay that once a year. I pay my HOA once a year. The insurance, which is your insurance that you get from State Farm, you can pay it annually. You can pay that once a year. In fact, that is the best way to do that if you can afford to, because you get a lot of discounts to doing it that way. So you can pay that once a year. The PID and the MUD, all of those are going to be going together with your property taxes. So, but let's get into these step by step. Okay, let me explain each component. The first one is the principal. The principal is the loan amount. This is the amount that you borrowed. For example, a house that is $500,000. Um, if you're trying to purchase that house and you put down 10% of 500 is 50,000. That means your down payment is 50,000 and the bank lends you 450,000. That is the loan amount, also the principal. That also called the principal. So that's the amount that you borrowed. The next is the interest rate in this case. Interest rate is the cost of borrowing the loan. That is the amount that the bank charges you to lend you that money. And interest rate is going to vary. It's going to vary. It goes up and down if it's not fixed. We are going to discuss that in detail. Okay, so don't worry. And interest rate is different from APY, which is the annual. The API is the cost, is the true cost of the loan for the first year. Okay, so the next is going to be taxes. This taxes is different from the income tax that you file every year. This is property taxes. This is every property, or most properties, especially I am in Texas, so let's talk about Texas specifically. Most properties in Texas are going to be in a county that has a tax rate. I live in Frisco. For the most part, for simplicity's sake, the tax rate here is 2%. So if you own $1 million house in this county, your taxes every year, if you don't have homestead, is going to be $20,000. That is the money that the county collects. They use this money to fund our schools. That is why we have really, really good schools. Let me not say that, because higher taxes does not equate to better schools. In this case, in Frisco, we have pretty low property taxes. I hope they're not listening. It is high enough for me. And then we have good schools also. So just to put that out there. Then there's the insurance. The insurance in this case means exactly what it says. The insurance is the insurance that you get just like your car. The insurance that protects your house against fire and stuff like that. So just like your car, protects your house. You get this from Allstate, Farmers, wherever you get your insurance from. It is best to bundle it with your car insurance and all the other insurances that you have. You get some discounts that way. Again, I am going to go into details and explain the best ways to go about all of these things. Okay. So the next is the PMI. PMI is the private mortgage insurance. This is the insurance that your bank gets or your lender gets to protect them in case you default on your loan. Think about it this way. When you buy a house that is $500,000 and you go through a conventional mortgage, you're allowed to put as little as 3%. So that's 15,000. So with 15,000 only, it's not only, but it's only compared to what I'm talking about. With $15,000, you can purchase a house that is $500,000. You see where the only came in. Um, what that means is you put down 15%, 15,000, which is 3%, and the bank lends you 97% of the cost of the house. You don't have, by all parameters, you don't have enough skin in the game. 3% compared to 97, the bank does not think you have enough skin in the game. So they want to protect their investment. So they're going to get an insurance on your mortgage called private mortgage insurance. This insurance is going to depend, the cost of this insurance is going to depend on a few things: how much your credit score, and how much your down payment is. We're going to go into details on this also. Okay. The next thing is going to be also PMI relates to conventional loans, but in FHA loans, PMI is called mortgage insurance premium. So same thing. We're going to talk about that later. Then there's HOA. HOA stands for Homeowners Association. When you buy a house that is in a subdivision, more than likely, there's going to be an HOA. There are very, very few instances where a property does not have HOA. That means people live far out of the city they live. far away in the country, in the countries and the outskirts of the city, and there's no governing body. They can mow their lawn if they want to. They can paint their house pink if they want to. Uh, there's nobody regulating it because it's not an HOA. But in most cities that are closer to the city, you're going to have an HOA, which is homeowners association. This is going to be, for the most part, it's going to be run by members. The board is going to comprise of members, people that live in that community. Then they typically hire a management company to manage the community. This HOA tries to make sure that they maintain the neighborhood. They make sure that everybody mows their lawn. If it's a townhome, they actually mow your lawns for you. But in certain neighborhoods, like my neighborhood, they mow the front, but not the back. But they also make sure that nobody paints their house pink. They make sure that nobody paints their house green or red. Um, because if everybody is allowed to paint their house however whatever color they want to, the neighborhood is going to look like a mad place and the property value is going to go down. So HOA serves the purpose of maintaining the neighborhood. So they charge you a fee for it. The fees can be significant, especially in townhomes. Townhomes, the HOA can be as much as $300. We own a property in Las Colinas where the HOA went as high as $340 a month, $340 a month, and that was insane, considering it was a townhome. Um, so that's it for HOA. We're going to talk about that in detail again. Then there's a PID. PID is Property Improvement District. Property Improvement District. This is also another, call it a tax. This is call it a tax, but it's used to fund special projects that the members or the owners of a community in a community benefit from. Does that make sense? Like you guys want to have an excellent resort, you want to have you see neighborhoods, especially in the Dallas area, that are starting to look more like a five-star resort. They have beautiful pools, they have a lagoon, etc. These things are paid for by a PID. Then there's a MUD. A MUD is going to be it stands for Municipal Utility District. This is collected. This is a certain type of tax that is collected to manage utilities like water and sewage. We're going to get into it in detail. So far, I have explained to you that a mortgage could comprise of principal, interest, taxes, insurance, PMI, which is private mortgage insurance, HOA, which is HOA fees, and then there could be a PIT. So that's PITI, PMI, HOA, and PIT. So that's seven payments. A lot of people show up ready for four, and they can have as much as seven. You don't see, we're starting to see PIDs more often, but it's not something that you see all the time. It's not, I would say, less than 50% of the time you're going to see a PID. Don't quote, I haven't taken, this is not a scientific guess, it's just my guess. So, but more than likely, a property is not going to have a PID. But every other thing, if you don't put down 20%, you're going to have a PMI. If you live in a neighborhood, you're going to have a HOA. So prepare for at least six payments. Okay, so let's go. And I've explained escrow to you. Escrow again is the bank collects all of these fees that are not due until a later time, but they want to collect it for you because they want to make sure that you have the money when it's due. Because if they let you pay it when it's due, and it shows up, it ends up being that you don't have the money, then the house can get foreclosed on and the bank loses money. The bank does not want that. So the bank makes it easier for you, or so you can argue that they argue that they make it easier for you to afford that because they collect it every month for you. So we're going to talk about that in details later on. So we've talked about PIDs. Let's talk about PID a little bit more. PID stands for Property Improvement District. In the state of Texas, the state statute grants cities and counties the authority to levy assessments against properties in their district in order to fund specific improvement benefiting those properties. So remember, it benefits those properties. These public improvement district taxes pay for community enhancements like road construction, water distribution, wastewater collection, landscaping, city park recreation opportunities, and more. Paid assessments are generally calculated based on the size of the property. They are fixed assessments that expire once the upgrades are complete. So they go away after a few years. They are not evil. They are used to make your community beautiful and build something that a lot of people enjoy in the communities. Now let's talk about mud because we're trying to compare pit versus mud. A mud is similar to a pit in some respect, but they're not the same. Both have local taxing authority under the Texas tax code, but the primary difference between them lies in the intended use of any collected taxes. A municipal utility district is created to finance, build, maintain infrastructure and services related to water, sewer, and drainage in areas that are otherwise unmanaged by local governments. Because think about it this way, typically the city manages your water and sewage, right? But there are going to be instances where, for some reason, it is outside of the jurisdiction of the city, then you guys have to use you levy the mud. I mean, you levy the tax called the mud to take care of those things. When we owned the property in Las Colinas, we had a mud. We had a water utility district. It was difficult for us to understand why we did not like it, but it was there. So this is going to depend on where you buy a house from. So each time you're trying to buy a house, one of the first questions I want you to ask your realtor is, does this property have a pit or a mud? Don't forget that. Write it down now, okay? Make sure you ask the realtor, does this property have a pit or a mud? The builders are required to disclose this. Often they send you they use their own contracts. It's in there, but a lot of times people don't spend time explaining to people what these things are, or they explained so summarily that people just sign and then get upset later on. So I am taking time to explain this to you because it has been an issue. It's been on the news where a lot of people bought houses and they started getting all these bills and they didn't know what it was. So there's a pit. You can have a pit or you can have a mud. Okay. So let's go into details now. So we're going to discuss each component. For example, the principal and the interest rate. I'm going to teach you how to optimize all of these things. Okay. So the principal is the first one, and we're going to go into deeper. We're going to go deeper into the principal. The principal, remember again, is a loan amount. It is the cost of the house minus the down payment. A lot of times, people are going to tell you, yeah, just put down the minimum amount, 3%. You're going to see homes on Instagram. They're going to put a $500,000 house and they're not going to put the price. They're just going to put with only 15,000 you can buy this house, and that gets everybody completely interested. Think about it. Instead of telling you that this house costs 500,000, the advertisement says with only $15,000 you can buy this house. It is true, but what's going to happen is if you buy a $500,000 house and put down only 3%, you're going to be borrowing $485,000. That means that your payment is going to be pretty high. The lower the amount, the down payment that you put on a house, the higher your interest rate. Okay, so and the higher your payment. So on a conventional loan, you can put 3%, 5%, 10%, 15%, 20%. You can put any of that down. Um, yes, you can. But remember, the lower the amount that you put down, the higher the amount that you borrow, and the higher your payment. So that's it for principal. Okay. Let me say that again. The lower the amount that you put down, the higher the amount that you're borrowing, and that's going to be the higher your payment. Okay, so we're going to go to interest rate now because this is where this is the main area that I want to spend some time on. Your interest rate. Interest rate is such an interesting topic, and it's very very hard for a lot of people. It's a very interesting topic. So let's get into it. Interest rate is the fee that the bank charges you to buy a house, to borrow the amount to buy a house. In 2021, it was 2%. This is 2024. It is 7%. I bought a house last November. The rate they gave me as an investor was 8.25%. So rates have gone up. And between 2021 and 2024, that is a 3-year period, right? Rates have gone from 2% to over 8%. So that is how much it can change. In general, consumers with higher credit score are going to get better rate. If I have 800 credit score and you have 620, you're going to get a worse interest rate than I did. Vice versa. If I have a credit score of 620 and you have a credit score of 820, you're going to get a better interest rate than I did because your credit score is better. You are deemed as a more responsible or more worthy or more capable borrower. Therefore, your loan is less risky. Therefore, they're going to give you the better interest rate than they will give me. So that's number one. Number two is, so we're discussing essentially factors that affect interest rate. Okay. The second factor that affects interest rate is going to be home location. Believe it or not, interest rate differs from states. Some states actually have lower interest rate than others. Some have higher than others. So that we're just going to leave it at that. Then the third factor that affects your interest rate is the amount of the down payment. See, we just talked about that in the principle, under the principle. In general, a larger down payment means a lower interest rate because lenders sees you as a lower risk, lower level of risk when you have more stake in the property. When you have more skin in the game, the lender is more comfortable lending you money. Again, let's use that example of a $500,000 house. If I put 20% down, that means I gave them $100,000. I give them $100,000. So they're lending to me 400,000. The bank feels like it's it's less likely that I am going to wake up one day and decide I'm not going to pay for this house anymore and just walk away. Because if I walk away, I'm going to lose $100,000. Most people don't want to lose $100,000. In essence, the higher the down payment that you put, the less risky your loan is, and the better interest rate that you get. So if you put down 5%, that's good, but you're going to get a higher interest rate than somebody that put 10%. If you put 10%, that's good, but you're going to get a higher, or more than likely, going to get a higher interest rate than somebody that put 15%. If you put 15%, that's also good, but more than likely, you're going to get a lower interest rate, a higher interest rate than somebody that put 20% down. And somebody that put 20% down, more than likely, is going to get a higher interest rate than somebody that put 25% down. So the more you put down, the less your interest rate. I hope that explains it. The fourth factor is going to be the type of loan. A lot of times, FHA loans have lower interest rate than conventional. Don't celebrate yet, okay? People have started, I've seen people that qualify for conventional try to get FHA loans because of this factor, especially now that interest rate is very, very high. People are hungry for rates that are lower. So I've seen people that would normally qualify for conventional go for FHA. I've seen builders representatives sell it to them. Oh, well, you can go to FHA. And I tell the builder, well, that's not in their interest. Well, they tell me, yes, but in this case, it helps them buy the house. So FHA might have slightly better interest rate than conventional. However, there is something called upfront mortgage insurance premium. They charge you a 1.75% fee. So you put down, so let's get back into that. So FHA requires you to put down at least 3.5%, whereas conventional allows you to put down as little as 3%. With FHA, however, you're going to pay an upfront mortgage cost that is 1.75%. But that's not the case in conventional. So while you might be getting a slightly better insurance or interest rate, they're going to charge you a ridiculous amount of fee. So if you do qualify for conventional, in my opinion, you need to stick with conventional because the main reason is because when you have paid up to 20%, when you've up to when you've made when you've attained up to 20% equity in the house, let's say the house was $100,000 and you put down 10%, which is 50,000. Over the years, when you keep paying and you get to where you've put down or paid 100,000, that means you've met 20% equity in the house. Your private mortgage insurance falls off. In FHA, it is not. You have to keep paying that for the life of the loan unless you go back and refinance. That's the only way to get refinance it to conventional. That's the only way you can get that out. So FHA has its perks. Conventional has its perks. I prefer conventional. This is my personal opinion. People are going to tell you different. I prefer conventional over FHA any day, even though sometimes you get a better interest rate with FHA. The next is going to be the type of interest rate. There's an ARM versus a fixed. An adjustable rate mortgage, or is also called an ARM. This is typically going to have a lower interest rate than a fixed. But ARM is not always a good idea, in as much as it has a lower interest rate from the start. After it stays fixed for a certain amount of period, then after that it goes up. Whereas a fixed mortgage, while it might be a little bit higher than an ARM, stays fixed for the life of the loan until you refinance it. So if you don't want any surprises, an R a fixed mortgage is the way to go. So again, the factors that affect interest rate would be your credit score, the home location, the amount of down payment. Remember, the more you put down, the less your interest rate is going to be. The type of loan, FHA versus conventional. FHA is going to have a lower interest rate than conventional. The type of interest rate, if it's an ARM versus fixed, an ARM is going to have a lower interest rate from the start than a fixed. Now let's get into property taxes. So we're going to discuss property taxes in detail, and we're going to talk about the factors that affect property taxes. The first factor that affects property taxes is the location. I live in Frisco. Frisco has about a property tax rate of 2.0%. They voted last year to lower it. I think it's a 1.9, if I'm not mistaken. Don't quote me on that. You can check that on the website. Now, compared to somewhere like Garland, compared to somewhere like Mesquite, compared to somewhere like Las Colinas, these other cities I've mentioned have a much higher interest rate of property tax rate than Frisco. So the other thing that I want you to ask your realtor, take note when you're trying to buy a house is, what is the tax rate in this property, on this property that you're trying to sell me? Okay. Find out what the tax rate is. Make sure it's not something that's absurd. Make sure it's something you can afford. Okay. That's number one. Number two is the year. Like I mentioned, we had a tax rate, and the past year, voters voted to lower our tax rate. So the voters or the residents in the community can vote to either lower or increase their tax rate. The next thing is the management. If you have bad management, if you have a bad mayor in your county, they're going to misuse your funds and you're not going to have enough money. And therefore, you're going to have to vote to increase your taxes. They're going to raise your taxes. And also, I wanted to mention that better schools is not equal to higher tax rate. There are cities that are run very well that have low tax rate and still have better schools. Frisco is an example of one of such cities, Frisco, Texas. Uh, Now let's go to and you can also go online and find out what the tax rate in a particular property is. It's something I encourage you significant. I encourage you seriously to look into before you purchase a house. Okay, find out what the tax rate is and find out if it has a pit or the mud. The next thing is the insurance. I wanted this video to be pretty short, so I'm going to kind of go through these fast now. The insurance is your insurance. We're talking about your normal insurance now. The insurance is going to depend. If you want to get a better interest rate, it's smarter to bundle. So you want to get a quote from, if you have your car note, if you have your car insurance with insurance XYZ, you also want to shop that insurance XYZ for your home insurance. A lot of times they give you a discount if you bundle. This is the only time that bundling actually makes sense. Also, the payment terms. Like I mentioned earlier, if you pay your insurance once a month, once a year, like you go in, they give you a quote, you're gonna ask them, what is the annual? If I paid this thing for a whole year at a time, how much is it gonna cost me? You are going to find out that you get a good amount of discount paying for it annually if you can afford to versus monthly. Then there's the neighborhood, the zip code. Certain neighborhoods or certain zip codes have higher insurance rate than others. This could be due to crime rate, etc. Then there's dwelling coverage, the amount of house that you're trying to cover. Then there's the claim history. If you filed claims in the past, just like an insurance, there's your credit history also. I see marital status here. I did not know about this. I just saw that. I don't know how marital status affects your insurance, but it's on here. The age of the home, the older the property, the more claims you might need to file on it. Therefore, the higher the premium. There is also your deductible. The deductible on the property is something that you have control of. For example, if your deductible on a house is 1%, on a $1 million house is 1%, you're going to get one rate. But if you raise your deductible to 5%, knowing fully well that that means that if something happens to your house, you're going to have to come out of pocket for more. If you're comfortable with that, your insurance is going to be significantly less. So there are going to be years where you say you're struggling, it's up to you. You can look. Just know that you can increase your deductible and get a lower rate on your insurance. It might not be advisable for certain periods for certain people. If you don't have a good reserve of cash, increasing your deductible might not be a good idea. But if you have a lot of reserve and you feel like, okay, if my house burned down and they paid I can put down 5%, and if they cover the other ones, then this might be a good move for you. Then there's of course inflation. We're going through inflation right now. Everything is higher, as well as insurance. So inflation does in fact affect your insurance rate. Now, we're trying to compare PMI versus MIP, the factors that affect your PMI. Again, like I mentioned earlier, your PMI, your private mortgage insurance, is going to be affected by the down payment, the amount of down payment that you put in. If you put down 10%, if person A puts down 10% as a down payment and person B puts down 15% as down payment, person B with the 15% down payment is going to have a lower PMI than person A. If everything else is equal, if all things are equal, ceteris paribus, more than likely the person that has a higher down payment is going to have a lower PMI than the person that has a lower down payment. Your credit score also affects your PMI. Remember, that's what I said in the first one. I said all things being equal. The person with a higher credit score, with 800 credit score, is going to have a better PMI than the person that has a 620 credit score. There's of course lender policies. In fact, some lenders have lender paid PMI. Some physician loans have lender paid PMI. Don't have any PMI in them. Also, the mortgage loan amount. If you are well, this is pretty much the same as down payment because the more you put down, the less your PMI is going to be. Then there are, of course, market conditions. We're going to go into HOA. HOA is the next one, and we're almost done. Factors affecting HOA is type of property. An HOA in a townhome is going to be significantly higher than HOA in a residential house, in a 1 to 4 residential home. The reason is the HOA in a townhome mows the lawn, maintains the exterior of the house. You know, you have a shared roof, so the HOA gets insurance to cover your roof. The HOA covers the exterior of the house. Mow your lawn, water your, maintain your landscaping and all that stuff. Whereas so you have a higher HOA, but in a residential house, in a 1 to 4, you mow your own lawn, you do pest control yourself, you take away the weeds, you weed your house and all that stuff. HOA covers very little. Your roof is not shared. You own your roof, so your HOA does not cover that much. Does not have that much things to cover. Therefore, your HOA is going to be cheaper. Now, what's going to happen is like the insurance on since in a townhome, since the HOA covers the exterior of the outside, the exterior of the house, your insurance on townhomes are going to be cheaper because remember the HOA covers the roof and the exterior. So you essentially get an insurance for the inside. Versus in a residential house, your insurance is going to be significantly higher, almost twice what it is in townhomes because you're covering everything. So remember I told you guys that we're going to talk about whether HOA and whether how it all evens out. So if you think about the fact that you have to mow your lawns in your residential house twice a month, so that's $40, $50 2 times a month. That's $100. You're gonna have to do pest control. You have to weed. You have to mow your lawn. All of that stuff. Versus in a townhome where the HOA does all of that stuff, but the HOA fee is higher, but your insurance is lower. You're gonna have to find out which one is better for you. So I don't want you to not get a townhome because you think the HOA is high. Okay, so let me repeat that. You should not get a townhome when it is in your best interest because you're looking at a HOA that's high. Because remember, the HOA is high, however, your insurance is going to be lower. And the HOA is high because it's going to cover a lot more things. It's going to maintain the exterior of the house, and your insurance is going to be lower. Versus in a residential house, you are going to have to mow the lawn, especially when you're an investor and you're a landlord. You and the tenant will have to discuss who is going to maintain the lawn, who's going to mow the lawn. And this is why, as an investor, I like townhomes a lot. So that's just my personal opinion. The other factor is going to be the covenant, the original documents governing the neighborhood, whatever they decide, whatever things they put in and take out, that's going to affect our HOA fees. Also, if a community is gated, once a community gets gated, that means that the city, it becomes private property. The city no longer maintains the inside of that of the gated community. That means that you guys, the residents, are going to have to pay for that. So whenever a community is gated, a lot of people like gated community, but what that usually means is going to be higher HOA fees versus a not gated community. Okay, services, we talked about that. The services that HOA provides is going to affect how much you pay. Where I live in Frisco, my HOA is ridiculously high because for some reason they give us ADT. They mow the lawn. In the winter, they paint the grass green and it's stuff like that. So they provide security and stuff. So they charge a lot more. It's a lot more. It's 4 times what it should be in normal subdivision. But we like the community. We live here and we know it up front and we love living here. So, in summary, we have talked about the mortgage. I have talked to you guys. I've tried to spend a lot of time. This video has gone longer than I wanted it to be, but I hope that I spend a lot of time going into details, teaching you all the components of your mortgage, the principal, the interest, the taxes, the insurance, the PMI, and the HOA, and the factors that affect them. Um, if you have any questions, my Instagram account is called Dr. Realtor. It's DR Dr. Realtor. I'm going to put it in this video. I'm going to put it underneath here. I want you to subscribe. I want you to share this video. I want you to share with your friends. I am committed to making sure that you know as much as much about real estate as anybody in this country. I don't want you to be at a disadvantage because you do not know what is going on. You do not know what questions to ask. So as throughout this video, I've come up with some questions that I wanted to ask your realtor to make sure that you're making the best decision. We've talked about home or townhomes versus residential homes and in situations where you're an investor. I hope I've given you enough information to help you decide not to put down 3% on a house and spend 10% furnishing it. You will see a few people situations where people that don't have the understanding of the things I explained here put 3% down because they tell them this is the least amount that you can put in. Then they spend 10% of whatever the property is going to cost in furnishing it and decorating the house and doing all these upgrades on the house. It could be penny wise, pound foolish because the fact that you put 3% down is making you pay more of everything. It's making you pay a higher PMI. It's making you pay a higher interest rate, and versus putting more money down and taking a year to decorate or upgrade your house. It might be a smarter move. So please subscribe, share this video. Thank you again for being part of my YouTube. Watch out for more videos. Thank you very much. Have a good day.